Hello and welcome to CMS Forex News. I'm market analyst Nick Nassad. Today is Thursday, May 7, 2009. The European Central Bank cut its benchmark interest rate by 25 basis points to 1%, as was expected. The big news from today's decision, however, comes in the form of a unanimous decision to use 60 billion euros to buy bonds. There's been a fierce debate among ECB policymakers if this is an appropriate action, with policymakers contradicting each other over the last month. With the bank moving into this unconventional territory, this rate cut may be the last one for now, though some observers believe the scope of the plan to buy bonds is too small. In a positive piece of fundamental news from the Eurozone, Germany's March factory orders climbed 3.3%, surprising forecast that had called for a close to 1% drop. The increase reversed the upwardly revised 3.1% decline seen in February and is a sign that the Eurozone's recession may be moderating. It was also the first increase in orders since last August. The better German factory orders data and the announcement by the ECB that it will start buying bonds helped spur a rally in the euro-dollar pair. After retesting yesterday's low near 1.3250 overnight, the factory orders data gave the euro a boost, which was followed by a rise to 1.3470 after the ECB decision and a better-than-expected U.S. jobless claims report. Following that spike, however, the euro pared some of its gains, returning to the 1.3360 level as U.S. stocks traded in the red, increasing the appeal of the greenback in New York trading. The Bank of England, meanwhile, held rates steady at 0.5% today, though they too announced more quantitative easing measures. The bank said it will spend an additional £50 billion to purchase corporate and government bonds. So far, the bank has bought £51 billion worth of securities after initially pledging to buy £75 billion over 3 months. That figure will now rise to £125 billion. Unlike in the case of the euro, today's announcement from the Bank of England brought the pound under pressure. The bank will have to print more money to finance its purchases of bonds, and that carries the risk of deflating the value of the currency, though the steps taken by the Bank of England should help to get the economy out of recession sooner. The pound, after almost touching the 1.52 area prior to the announcement, fell down to the 1.4950 level in afternoon New York trading. That down move broke below short-term support at the 1.50 level. The U.S. labor market got a second bit of good news following yesterday's better-than-expected ADP report. First-time claims for unemployment benefits fell to the lowest level since late January in the week ending May 2nd, a sign that perhaps the worst of the layoffs in response to the current recession could be behind us. Initial claims fell by 34,000 to 601,000. The report did show that the total number of people continuing to receive benefits kept on rising, hitting a fresh record high of 6.35 million. Tomorrow, the U.S. will post its non-farm payroll report for April, and economists are currently looking for a drop of around 580,000. In a second release from the U.S., the Department of Labor showed that labor productivity increased 0.8% in the first quarter, while labor costs rose 3.3%. Companies are trying to squeeze more output out of their workers as they are unwilling to hire new employees during the recession. Higher labor costs means higher wages, which could help increase consumer spending. The positive jobless claims data helped cap a rally in the U.S. dollar-yen pair at the 99.70 level, following a rally of 140 pips from today's open. The greenback gave up that intraday high and traded about 70 pips lower as the Dow Jones index was off 110 points, the Nasdaq was off 47 points, and the S&P 500 dipped 15 points in late New York trading. Still, the greenback was higher today following a 3-session downtrend against the yen. Looking at some other fundamental data that came out today, New Zealand saw its employment level fall 1.1% in the first quarter, with the unemployment rate increasing to 5%. Increased joblessness will hurt consumer confidence and impact spending. In Australia, the story was much different. The Australian economy created 27.3 thousand jobs in April, and the unemployment rate fell to 5.4%, results that surprised forecasts. Expectations had been for a 25,000 decline and a rise in the unemployment rate to 5.9%. The Aussie US dollar continued its climb today, reaching the 0.7613 level in early New York trading, prior to the burst of risk aversion in late New York trading. The pair jumped above the 0.75 area after Australia released its better-than-expected jobs report. The decline in U.S. stocks caused the U.S. dollar-Canadian dollar pair to reverse part of yesterday's move, with the pair trading near 1.1740 in late New York trading. That stalls a downtrend that has seen the pair fall from the 1.25 area in the past 3 weeks. Overnight, Switzerland will release data on unemployment, Germany posts its trade balance and industrial production data, and the UK will reveal its producer price index. Tomorrow, the US releases its non-farm payroll report along with wholesale inventories, while Canada posts its employment report along with a release on housing starts. And that concludes today's broadcast. Thank you very much for joining us here at CMSFX.com, and happy trading.